It is clear that the concept of America printing her own debt-free money sent shockwaves throughout the European central banking elite. They watched with horror as Americans clamored for more greenbacks. They may have killed Lincoln, but support for his monetary ideas grew. On April 12, 1866, nearly 1 year to the day of Lincoln's assassination, Congress went to work at the bidding of the European central banking interests. It passed the Contraction Act, authorizing the Secretary of the Treasury to begin to retire some of the greenbacks in circulation and thereby contract the money supply. Authors Theodore R. Thorin and Richard F. Warner explained the results of the money contraction in their classic book on the subject, The Truth in Money Book.
The hard times which occurred after the Civil War could have been avoided if the greenback legislation had continued as President Lincoln had intended. Instead, there were a series of money panics, what we call recessions, which put pressure on Congress to enact legislation to place the banking system under centralized control. Eventually, the Federal Reserve Act was passed on December 23, 1913.
In other words, the money changers wanted two things: the reinstitution of a central bank under their exclusive control, and two, an American currency backed by gold. Their strategy was twofold. First of all, cause a series of panics to try to convince the American people that only centralized control of the money supply could provide economic stability. And secondly, remove so much money from the system that most Americans would be so desperately poor that they either wouldn't care or would be too weak to oppose the bankers. In 1866, there was $1.8 billion in currency in circulation in the United States, about $50.46 per capita. In 1867 alone, $500 million, $500 million, was removed from the U.S. money supply. 10 years later, in 1876, America's money supply was reduced to only $600 million. In other words, 2/3 of America's money had been called in by the bankers. Only $14.60 per capita remained in circulation. 10 years later, the money supply had been reduced to only $400 million, even though the population had boomed. The result was that only $6.67 per capita remained in circulation, a 760% loss in buying power over 20 years. Today, economists try to sell the idea that recessions and depressions are a natural part of something they call the business cycle. The truth is, our money supply is manipulated now just as it was before and after the Civil War. How did this happen? How did money become so scarce? Simple. Bank loans were called in and no new ones were given. In addition, silver coins were melted down. In 1872, a man named Ernest Sed was given 100,000 pounds, about $500,000, by the Bank of England and sent to America to bribe necessary congressmen to get silver demonetized. He was told that if that was not sufficient, to draw an additional 100,000 pounds or as much more as was necessary. The next year, Congress passed the Coinage Act of 1873, and the minting of silver dollars abruptly stopped. In fact, Representative Samuel Hooper, who introduced the bill in the House, acknowledged that Mr. Sed actually drafted the legislation. But it gets even worse than that. In 1874, Sed himself admitted who was behind the scheme.
I went to America in the winter of 1872-73, authorized to secure, if I could, the passage of a bill demonetizing silver. It was in the interest of those I represented, the governors of the Bank of England, to have it done. By 1873, gold coins were the only form of coin money.
But the contest over control of America's money was not yet over. Only 3 years later, in 1876, with 1/3 of America's workforce unemployed, the population was growing restless. People were clamoring for a return to the greenback money system of President Lincoln, or a return to silver money, anything that would make money more plentiful. That year, Congress created the United States Silver Commission to study the problem. Their report clearly blamed the monetary contraction on the national bankers. The report is interesting because it compares the deliberate money contraction by the national bankers after the Civil War to the fall of the Roman Empire.
The disaster of the Dark Ages was caused by decreasing money and falling prices. Without money, civilization could not have had a beginning, and with a diminishing supply, it must languish, and unless relieved, finally perish. At the Christian era, the metallic money of the Roman Empire amounted to $1,800,000,000. By the end of the 15th century, it had shrunk to less than $200 million. History records no other such disastrous transition as that from the Roman Empire to the Dark Ages.
Despite this report by the Silver Commission, Congress took no action. The next year, 1877, riots broke out from Pittsburgh to Chicago. The torches of starving vandals lit up the sky. The bankers huddled to decide what to do. They decided to hang on. Now that they were back in control to a certain extent, they were not about to give it up. At the meeting of the American Bankers Association that year, they urged their membership to do everything in their power to put down the notion of a return to greenbacks. The ABA Secretary, James Buell, authored a letter to the members which blatantly called on the banks to subvert not only Congress, but the press.
It is advisable to do all in your power to sustain such prominent daily and weekly newspapers, especially the agricultural and religious press, as will oppose the greenback issue of paper money, and that you will also withhold patronage from all applicants who are not willing to oppose the government issue of money. To repeal the act creating banknotes or to restore to circulation the government issue of money will be to provide the people with money and will therefore seriously affect our individual profits as bankers and lenders. See your congressman at once and engage him to support our interest that we may control legislation.
As political pressure mounted in Congress for change, the press tried to turn the American people away from the truth. The New York Tribune put it this way on January 10th, 1878. "The capital of the country is organized at last, and we will see whether Congress will dare to fly in its face." But it didn't work entirely. On February 28, 1878, Congress passed the Sherman Law, allowing the minting of a limited number of silver dollars, ending the 5-year hiatus. This did not end gold backing of the currency, however, nor did it completely free silver. Previous to 1873, anyone who brought silver to the U.S. Mint could have it struck into silver dollars free of charge. No longer. But at least some money began to flow back into the economy again. With no further threat to their control, the bankers loosened up on loans, and the post-Civil War depression was finally ended.
3 years later, the American people elected Republican James Garfield president. Garfield understood how the economy was being manipulated. As a congressman, he had been chairman of the Appropriations Committee and was a member of Banking and Currency. After his inauguration, he slammed the money changers publicly in 1881. Whoever controls the volume of money in any country is absolute master of all industry and commerce. And when you realize that the entire system is very easily controlled, one way or another, by a few powerful men at the top, you will not have to be told how periods of inflation and depression originate.
Unfortunately, within a few weeks of making this statement, on July 2nd of 1881, President Garfield was assassinated.